The final section we'll cover about structuring a deal is to understand earnouts. And there's a lot here, so I have a good bit of content about them. Not every deal will have an earnout, but if you could, you probably should. So to start, an earnout is a payment structure in which a purchase or portion of the purchase price is contingent on the business meeting specific performance targets after the sale. Earnouts can help bridge the gap between the seller's valuation and the buyer's concerns about future performance. Contingent payments are based on future performance. So here's how earnouts work. In an earnout agreement, the buyer agrees to pay the seller additional amounts if the business achieves certain financial operational milestones after the acquisition. These milestones are typically based on revenue, EBITDA, or net profit metrics. For example, the buyer may pay initial $500,000 for the business, with an additional $200,000 payable if the business reaches $1 million in revenue in the next 2 years. Advantages for the buyer are that earnouts reduce the buyer's upfront financial risk, as part of the payment is tied up to the business's actual post-sale performance. This can provide the buyer with a greater deal of confidence in moving forward. And the great thing is that there's also advantages for the seller. Earnouts allow the seller to receive additional compensation if the business performs well under new ownership, especially if the seller believes the buyer has and will benefit from the groundwork that they've laid. In addition, there's also some challenges to earnouts. So the first is disputes over performance metrics. Earnouts can lead to disagreements over measuring performance. It's important here, though, to clearly define the metrics and methods for calculating earnouts early on and make it super clear and unambiguous. Operational controls number 2. Sellers may be concerned that changes made by the buyer post-sale, such as reducing investment or altering management practices, could impact the business's ability to meet earnout targets. And 3, monitoring and enforcement. Both parties must agree on how the earnout will be monitored and enforced. This could involve regular financial reporting or audits to ensure the agreed upon metrics are met.